Ladies and gentlemen, good day and welcome to Northern Arc Capital Q2 FY26 earnings call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Parth Jariwala from DAM Capital. Over to you, sir.
Thank you. Good evening, everyone. Welcome to Q2 FY26 earnings call of Northern Arc Capital Limited. I thank the management for giving us the opportunity to host a call. From the management team, we have Mr. Ashish Mehrotra, Managing Director and CEO, Mr. Atul Tibrewal, Chief Financial Officer, Mr. Parthasarathy Ralabandi, Group Risk Officer and Governance Head, Mr. Chetan Parmar, Head Investor Relations. Without further ado, I'll hand over the call to Mr. Ashish Mehrotra, MD, for his opening remarks, post which we can open the floor for Q&A. Over to you, sir. Thank you.
Hey, thank you, Parth. Thank you very much. Good evening, everyone. I'm delighted to welcome you in today's call. Thank you for joining us for today's conference to discuss Northern Arc Capital performance for the quarter ending September 30th, 2025. I'm also joined by my colleague, like Parth said, Atul Tibrewal, our CFO, Parthasarathy Ralabandi, our Group CRO and Governance Head, Jigar Seta, Head of Strategy, Chetan Parmar, Head of Investor Relationship. Let me begin with macroeconomic environment. I think India continues to demonstrate remarkable resilience despite global uncertainties, including tariff-related pressures, geopolitical tension. In the last 15 months, Indian economy had faced multiple headwinds, including slowdown in urban consumption, private credit investments, decline in manufacturing activity, rising protectionism, and supply chain disruptions. However, fair to say, in the recent policy measures, notably in income tax, GST, RBI, liquidity and regulatory easing initiatives, are expected to stimulate the consumption and support a broader economic revival. A normal monsoon will further add to the rural demand and stability. Together, these factors are poised to strengthen the country's growth momentum in the coming quarters. Following the repo rate cut earlier this year and the recent government stimulus through GST rate reduction, expected to provide a flip to consumption, creating supporting environment for higher growth in the second half of FY26. We began witnessing early signs of revival in credit growth towards the later part of quarter two, and this positive momentum has further strengthened through the October, reflecting an improving credit demand environment across the key segments where we operate. Our assets under management grew by about 15% on a year-on-year basis and about 6% on quarter-on-quarter basis to 14,166 crores, reflecting the early signs of momentum which is in line with other players in the market. However, excluding the rural finance book, which we consciously calibrated, the growth would have been 22%, which would have been better than the industry growth rate. Growth was predominantly driven by a direct-to-customer segment, which accounted for 54% of our total assets under management as of September 25. Direct-to-customer AUM grew by about 17% from 6,498 crores in September 22 to about 7,628 crores in September 25. Excluding the microfinance or rural finance business, our direct-to-customer business assets under management has grown by about 32% on a year-on-year basis, which is in line with a guided strategy to grow the direct retail book by over 30%. Growth in D2C segment is driven by strong momentum in the MSME space, which grew by about 42% on a year-on-year basis. To support this momentum, we've added another 100 employees across sales collection functions during the quarter and expanded our network with 50 new branches in FY26. These investments further strengthen our infrastructure, position us for sustainable growth in the coming quarters. MSME is a very vast opportunity which we are trying to make conscious efforts to grow. We are also building this brick by brick as it gives us a long tenor annuity income of secured asset pools. Our consumer finance business continued to demonstrate healthy momentum. Our assets under management has grown by 24% on a year-on-year basis. We are witnessing early signs of pickup in consumption demand, driven by credit demand supported by recent GST rate cuts and ongoing festival seasons. This positive trend has extended into October this year. We expect the credit demand in the second half of the year to be much better than that what we witnessed in the first half for this segment. Coming to rural business, we have consciously calibrated a microfinance portfolio while largely retaining a strong operational base of 285 branches, over 1,900 employees. Our incremental PAR 0 plus accretion has now reverted to the pre-stress level, reflecting a steady improvement in the portfolio quality. Notable fair to bring out that 80% of our MFI book comprises loans originated after implementation of the MFIN guardrails, and nearly 40% of our portfolio is covered under CGFMU, and incrementally we continue to cover portfolio as we originate new loans under this program. This sustained improvement in asset quality, supported by a robust infrastructure, gives us confidence and capabilities to scale up our MFI business as we go forward. Our intermediate retail, part of the credit solution business, has recorded a healthy growth of 13% on a year-on-year basis. Building on the recent GST cuts and festival season-led demand, we remain optimistic that the credit growth in the second half of the year will be stronger than in the first half, consistent with the guidance shared in our earlier calls. Our fee-based business, a key differentiator for Northern Arc, continue to complement our lending operation. Our performing credit funds has grown by 14% on a year-on-year basis to 13,196 crores. In addition, a few new funds in pipeline we expect to launch in the coming quarters, which will further enhance our assets under management and then strengthen our fee income. This underscores our strategic focus on building a comprehensive credit solution ecosystem rather than solely relying on the balance sheet-led model. Turning to asset quality, our credit performance remained best in class, supported by prudent risk management and conservative provisioning philosophy. We continue to maintain a very high-quality portfolio while proactively providing for stressed and unsecured exposures. The credit cost for the quarter improved to 2.7% compared to 3% in quarter one of this fiscal year, resulting in H1 credit cost of 2.8%, which remains well within our guidance of around 3%. Improvement was primarily driven by revival in consumption trends and improving economic environment, leading to stronger collection in the consumer finance segment. We also witnessed a decline in MFI provisions supported by our portfolio calibration and the fact that 80% of our book now in line with the new MFIN guardrails, and 40% of that is covered under the CGFMU. Additionally, our analytics-driven collection and recovery initiative further strengthened recoveries and helped contain slippages. We believe that the steps taken, including responsible and sustainable lending practices, focus on long tenure retail products, adoption of MFIN guardrails, and the coverage of all rural finance assets under CGFMU guarantee scheme will help stabilize delinquencies going forward. In addition, we have further strengthened our collection infrastructure, which is expected to drive continued improvement in recoveries across our retail portfolio in the coming quarters. Having said that, H125 credit cost stands at about 2.8%. As we move into the second half of the year, we believe we should be hold on to this momentum and numbers by end of the year and have a credit cost in a range of 2.6 to 2.8% that we have guided during the quarter one results. On the funding side, we're seeing the great work by our treasury team, able to negotiate to ensure that the passing down of the rate benefits reflecting in our borrowing cost. And that started reflecting starting from Feb to June borrowing we've done, which is lower than the MCLR rate. And I'm sure my colleague Atul will share more details about it later in this call. Overall, these positive development gives us a confidence that we are well positioned to achieve our guided AUM growth of 22 to 22%, and ROA around 2.8% plus for the year FY26. With that, I will now hand over the call to Atul to walk you through our quarter two numbers in detail. And thanks, Atul. Over to you.
Thank you, Ashish, and good evening, everyone. I appreciate all for joining the Northern Arc Q2 earnings call. Let me walk you through the financial performance. Our assets under management stood at 14,166 crores, reflecting a growth of 15% year-on-year and 6% quarter-on-quarter. Within the AUM mix, the direct-to-customer business contributed 54%, of which MSME finance was at 22%, consumer was at 26%, and MFI consciously calibrated at 6%. Net interest income for quarter two stood at 322 crores, which is up 12% YOY. The yield on advances have improved by 10 basis points quarter-on-quarter to 16.3%, and the cost of fund improved by 40 basis points quarter-on-quarter, resulting in NIM expansion of 40 basis points quarter-on-quarter to 9.3%. As Ashish highlighted, banks have started to pass on the benefit of the repo rate cuts through reductions in the MCLR. During Q2 FY26, banks' MCLR declined by close to 25 basis points. Of the cumulative 100 basis points reduction in the repo rate so far, about 40 basis points has been transmitted to the borrowers. This combination of lower MCLR rates and the repricing of our existing borrowing resulted in a 40 basis points sequential decline in our cost of funds to 8.5% in quarter 2 FY26 compared to 8.9% in quarter 1 FY26. The net revenue, including the fee income, rose 10% YOY to 344 crores. Fee and other income was at 21 crores. Our OPEX ratio for Q2 stood at 3.7%. The slight uptick in the OPEX was primarily on account of strengthening our MSME team, particularly in sales and collections. The pre-provisioning operating profit, or PPOP as we call it, for the quarter was 213 crores. Asset quality remained quite stable with GNPA at 1.15% and NNPA at 0.56%. Provision improved sequentially to 92 crores in Q2 compared to 102 crores in Q1. And this reduction was primarily driven by lower provisioning in the MFI portfolio and a revival in the consumption trends that supported stronger recoveries. On a percentage basis, the overall credit cost for Q2 improved to 2.7% compared to 3% in Q1. And as Ashish highlighted, we expect credit cost to remain stable in the range of 2.7 to 2.9% in the second half of the year. The profit after tax for Q2 increased by 13% quarter-on-quarter to 92 crores compared to 81 crores in quarter 1. ROA also improved by 22 basis points quarter-on-quarter to reach 2.6%. ROE for the quarter improved by 78 basis points quarter-on-quarter to reach 10.1%. On the liabilities front, in line with our debt strategy and AUM growth plans, we continue to diversify our funding base with a clear focus on long-term funds, including borrowing through the NCD and the ECB route. Liquidity remains very comfortable with positive cumulative mismatch across all the time buckets. As of September 25, we held surplus liquidity of close to 600 crores and undrawn sanctions of over 1,150 crores from various banks and institutions. Total borrowing at the end of the quarter stood at 10,331 crores with approximately 70% linked to variable interest rate, positioning us well to benefit from the ongoing decline in the interest rate. Our funding mix remains very well diversified with 25% sourced from offshore and DFI partners and the balance 75% from domestic banks, institutions and capital markets. Tangible net worth stood at 3,663 crores and which is up 10% YOY. We have strengthened the balance sheet materially. Our debt equity ratio also improved from 3.9 in March 24 to 2.8 times as of September 25. Capital adequacy remains quite strong at 24.6%, well above the regulatory requirements, giving us ample headroom to grow the balance sheet over the next 3 years. Thank you so much. So,
Are we good to begin?
yeah,
Are we good to begin the Q&A session, right?
go to the Q&A.
Okay. So thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Digant Haria from GreenEdge Wealth. Please go ahead.
Yeah, I thank you for the opportunity. It is good to see that, our credit costs have stabilized now at 2.7. But Ashish, just one question to you here that, in the next 2 quarters, which is H2, because your full year guidance is 2.6 to 2.8. So it means that, we may not see any reduction in credit cost. And generally we were thinking that because MFI and small LAP, the worst is probably behind for the sector.
No, like we said, anywhere between 2.6 to 2.77 and a half. I think we will hopefully should see an improvement. Like I said, the quality of the new book is both in case of rural finance or MFI is actually better than what we were seeing in the April 24, so which is pre-stress level. It is actually performing better than that. We're seeing sequential improvement across the portfolio. But if there is a residual stuff which needs to pass through, that will pass through. And that's one of the reasons why we are holding on to it. Obviously, with the investments in collection and in investments in analytics will allow us to get some more incremental gains. That's the position we're taking. It's always good to be prudent and make promises which we will give you positive surprises in.
Right. Okay, that's great. I always thought so that,
No, I'm holding on to what I said, and, everything we've said in a comment, we also refer to the earlier guidance. And it's important for us to build that level of in what we are saying and how we demonstrate the performance against the comment we make in this.
Perfect, Ashish. My second question is on the partnership business. Maybe the last 12 months, the growth was slow because, the underlying NBFC ecosystem in high yield lending itself was going through this entire macro stress. Next 12 months, do you expect better growth rates in the placement business and the partnership loan book, which is say around 6,700 crores? Is that possible?
I think, we look at credit solution as a single cohort. And if you refer to a slide, I think we are a very unique franchise with ability to underwrite large pool of retail loan across 7 sectors of retail credit. Process that through our own bespoke tech platform, underwrite it through a time-tested model, give it to institutional investors, give it to retail investors through our bonds platform called Altify.ai, invest in our funds, performing credit funds, and support from balance sheet. And I think that's the sequence we want to follow. So the focus is more towards building a holistic credit solution business rather than a simplified balance sheet-led approach.
Right. Okay. And just the credit costs for this division, the partnership division was slightly higher this quarter versus last quarter.
Like we hold some prudent provision in it. We've said that even earlier. I think those are incremental overlays we've taken, and as in the coming quarters, as we run through the situation, as we continue, we are seeing the improvement. The partner should also see the same improvement, which we're seeing in the flow rate. We will start releasing what needs to be released.
Great. And then now my last question is on the OPEX, that this quarter was slightly higher. Was it because of the collections infra we are building in the small lab?
The idea was to proactively also build back on the both, while we continue to hold the infra on the rural finance side, but we also wanted to build a lot more on the direct lending capabilities, and I thought it's a good thing for us to initiate it. We spoke about it. But our guidance on that remains range-bound. Our OPEX will remain between 3.6 to 3.7.5% to 3.8%, around that range. We are over that 4% mark long time back. We made the right set of investments. and if we continue to make investment, will remain well within the range point. You will see a movement between a quarter, and that's depending on how do you prioritize what expenses you undertake, but on a full year basis, we should land between 3.7 to 3.8.
Right. Perfect. Ashish ji. Thank you so much. Wish you all the best, and hopefully we wish to see 100 crore plus quarter soon. Thank you so much.
Yeah. Thank you.
Thank you. The next question is from the line of Shweta from Elara Capital. Please go ahead.
Thank you, sir, for the opportunity. Sir, could you throw some light on MSME credit, and have we to yet to assume that the challenges haven't subsided fully, because your transaction volumes sequentially have been slightly sluggish. The placement volumes also have been softer. Are we still sensing some challenges or pressures, or it's more to do with being slightly cautious?
Shweta, thanks. I think, like we said earlier, we continue to follow a calibrated and a little bit cautious approach. We do not represent in a placement business institution where we don't track risk. We are not like other arrangers. It is skin in the game for Northern Arc. So we consciously take a pool which we take for an institutional investor needs to pass through our pool filters. And that's why 90% of investors continue to buy pools from us for over 3 to 5 years. They are a large client, so I think that's where it is. There's also the demand on this sector has been slightly slow. That is one of the reasons. But on our own balance sheet, you've seen that business has grown tremendously, and we continue to see that growth momentum. I think as we get into H2 of this year, we're seeing massive traction building in our placement business and in our bonds platform. Those two will augur really well for us to build a fee franchise apart from the growth in the funds.
Sure. And so secondly, what contributed to higher credit cost on the intermediate retail segment?
Like I said earlier, it's a prudent provisioning which we're carrying on some of the accounts. There is no specific reason for us to do it, but we wanted to have enough management overlay given the stress which we witnessed or what we're seeing, the amount of credit which flows through. It's good to have prudent provisioning.
Okay, so just to follow up there, so even the stage 2 that sort of saw some spike sequentially emerged from, which portfolio contributed to this spike on stage 2?
I think that came in on the unsecured business loan side where we created some bit of provisioning, and that's one of the reasons why you're seeing a slight increase in the stage 2.
Sure, sir. Thank you so much.
Thank you.
Thank you. The next question is from the line of Shubhranshu Mishra from Phillip Capital. Please go ahead.
Hi, Ashish. Good evening. Thanks for this opportunity. Just wanted to understand which all sectors do we cater to in the MSME financing, and which all sectors are actually under stress? Are they tariff-related sectors, or are there some other kind of sectors? I believe we have a huge concentration in Tamil Nadu, which again has some hotspots for MSME, like Coimbatore, Tirupur, so on and so forth. So if you can speak about specifics within the MSME financing, it would be great. Thanks.
Okay, the way to look at our MSME business is a pretty broad spectrum. Our primarily big focus is to do lending with an average ticket size of 10 to 815 lakhs, which is secured by hard collateral based on perfect collateral with full MODT registration and customers under it. This is the financial or the projected income or the expected income or the derived income. So that means that's a very good quality business for us. We have large financing, and we're not seeing any stress. And there is a smaller component of an unsecured business loan, which is secured through by leveraging the RBI's filtering of 5% loss coverage. So I in our piece, that's the one way. So one, we cut it at 50. Our risk philosophy is pretty comprehensive, and we look at the risk both at a product level, geography level, going down to state level. To the point made both at a portfolio, whether it's to do with the rural finance portfolio or an MSME portfolio, nowhere we'll have more than 26% of our exposure in any district across product can have more than 5% of exposure. So we have this key hard-defined rails which we follow. That, to my mind, is the true power of a diversified lending business to ensure that you're able to navigate across cycles than
Understood. And my second question is on the MFI. We do CGFMU insurance. So what is the mass of the insurance? When does it kick in? And my sense is that unless one has less than 2% kind of GNPAs, doing an insurance with CGFMU doesn't really make sense. So in that case, is our MFI business built for more than 2% GNPAs?
No, I think let's I want to make one thing very categorically very clear. Our entire rural finance business runs on our time-tested lending scorecards. While we do follow JLG and a non-JLG financing model, which is more from acquisition, servicing, and the engagement with the end customers, but each loan approval is a function of NEO score. And we've, fair to say, at some point in time, we've underwritten over 60 million loans, either directly or indirectly. So scorecards determine whom we're going to lend. We've tested this scorecard again and again, and the all-new sourcing, effective March this year onward, is under FMU. Scorecard is actually non-negotiable. So we've tested it across last 36 months. We looked at it. We've done the look back. We've done the look forward analysis to ensure what quality of customer we want to do. We've also said that 80% of our all book, including new and old, follows the MSME guardrail. It means the quality of new assets is significantly better. Par zero acquisition on the newer vintages is less than 40 basis, 45 basis. So that tells you the quality of the book. I'm going to request my colleague Partha Sarvi to add more texture regards to risk here.
Ashish has covered specifically on microfinance. While the CGFMU cover is there to ensure that we don't have big volatility the way we have seen in the last few most of the market in most of the industry has seen in the last few quarters. That is not the basis on which we take credit exposures. Credit exposures are taken based on the risk that we see at the borrower level and if it is acceptable. To that extent, the portfolio is covered by CGFMU. I mean, all the portfolio that is originated from March 25 is covered by CGFMU. But again, that's not how the underwriting is done. It's not the basis on which underwriting is done.
Understood. Thank you so much. This was very helpful. Look forward to future quarters.
Hey, thank you.
Thank you. The next question is from the line of Chintan Shah from ICICI Securities. Please go ahead.
Thank you for the opportunity and congrats on a good set of numbers. So firstly, on the margins front, so margins have kind of seen a steep uptick, so almost 40 bits improvement, largely driven by the funding cost. So how much of the funding cost is yet to be, how much the borrowings are yet to be repriced? I understand the 70% of the borrowings are floating in nature, so most of them have been repriced, or do we anticipate some further benefit in H2 as well? That's the first question.
So thank you. I'm going to request Atul, over to you for all the great work Treasury has done.
Hey, thanks. Hi, Chintan. So on the liabilities front, Chintan, as you mentioned, our strategy is to diversify and with a clear focus on long-term resources. So this quarter, the key levers for us was issuance through the NCT and the ECB route. So the cost of fund, incrementally for us has been in the range of 8.7% consistently, which is best of the class in terms of our rating category. You will not have too many NBFCs with such a cost of fund in the AA minus category. Nevertheless, on your question of the interest rate, we have availed 50% of the benefit of the MCLR cuts, but repricing of around 50% of our balance liabilities is yet to happen. That will gradually happen in December and March quarter. Most of the borrowings actually takes place in the later half of the year, and most of them will come up for repricing after completion of a year or so, in December or March quarter. So we have good amount of headroom for further reduction. So we are very hopeful of a good set of numbers going forward as well. 70% of the interest rate is variable for us. Borrowings is variable for us, and this is very advantageous as far as the declining interest rate environment is concerned. So yeah, so this is a key contributor for us in the form of increased NIM expansion during the quarter.
Sure. So if you could also break that 70% into how much of that is linked to repo, MCLR, 3 months, 6 months, 1 year, as much as possible.
So I would say around 50% of that 70% would be linked to 1 year MCLR, and the balance would be 6 months, 3 months, or T-bills as well as the repo rate. So, but 50% would be 1 year MCLR, and most of the 1 year MCLR would have come up for repricing only in the later part of the year. But one good thing is that incrementally we are seeing not only we are getting the benefit of the lower MCLR, but the spreads have also come down. And the other important feature for us was the issuance of NCDs. I think that is very key to us. We have successfully raised a large NCD issuance in the previous quarter, and we'll be doing more such issuance in the coming quarters as well.
Sure. Now, on the OPEX front, actually, if I understand, the OPEX looks elevated largely because of the fee and commission expense. And if you look at the DuPont, the OPEX is like around from 3.5 to 3.7, but still that is some 2.4% increase in the employee cost. So, but this 3.7 should largely be the peak. So, more we don't expect any rise from that. This is largely in line with our guidance, right?
No, Chintan, the fee and commission that you see is actually netted off from the interest income, because this is the servicer fee that is paid for the partnership business, and this is in the investor presentation that you see. This is netted off in the interest income or the yields. So the OPEX of 3.7% is largely the employee cost and the other OPEX. And that has slightly increased, and as Ashish mentioned, primarily on account of the collection infrastructure that has been built over the last 3 to 4 months.
Sure. So this is likely, is there any scope for reduction here or no? Or this will be
I think this is, the guidance we had also given that we'll be, in the range of 3.7 to 3.8%. During the year, and I think we are still sticking to that guidance. We don't see too much of a movement as far as the OPEX ratio is concerned. It should be in this range going forward as well.
Sure. And I think if you could just help us with the number of 1+ BPD, if at all we can share that number for the portfolio, and how much was that a quarter ago?
Can we share it offline? If you run it by product, it will take much longer.
Chintan will share it with you offline, if that's okay with you.
Sure, no. And so just lastly on that HFC exposure, so any update on the HFC exposure? Where are we in terms of the legal process, or have we started to take the accounts payment in our books? So any update on that?
We've been doing that from the very beginning itself, and we did the direct assignment. We hold the title documents. All that is there, but and NASH, obviously, we've been presenting NASH, and the title documents are in our custody. We're working through with them. Since this is under sub judice, it will be unfair for me to disclose more.
Okay. So, and just one lastly on the fintech exposure. So, any stress do we see in the intermediate retail book among the fintechs or any other large accounts? Where are we seeing some stress, or is it business as usual?
I think it's business as usual. We've been prudently calibrated the growth across the sectors. If you look at it, and we've also been pretty prudent in terms of the volume growth. We don't want to unconsciously want to ensure we consciously look towards the high quality underlying assets when we finance and the lending practices. And that's why, the Q1 growth was, or the H1 growth was largely muted at 15%. I think we're seeing a better trend in the underlying books of each originating partner as we're seeing better quality of book and book coming in. We're happy to support with more liquidity solutions. And that holds true for placement, that holds true investments, that holds true bonds, everything else, including structured finance products.
Sure. Thank you. I think that's it from my side. Thank you, and all the best for the future quarters. Yeah.
Thanks.
Thank you. The next question is from the line of Hitendra Pradhan from Maximal Capital. Please go ahead. Mr. Hitendra?
Yeah, hi. Are you able to hear me?
Yes, sir, we are.
Yeah. So, sir, first question on the credit cost. So we have got in at 2.7% for this quarter. Now, a large part of it is also contributed by, higher credit cost in intermediate retail, which you said is part of a prudent framework. And the other thing is MFI. Now, given that both these things may not be sustainable in the next year, what kind of credit cost guidance would you look at the new book in FY27?
Hey, like I said, if you see, for intermediate retail, we created an overlay of prudent provisioning. We spoke about it. You've seen an improvement in the consumer from what it was in Q1 to Q2, and so is in rural. Like I said, that our new book, which we are originating, and if I look at it over the last 10 months, 12 months book, it is performing better than the pre-stress level. We're looking at the par zero accretion, and I spoke about it. It is lower than what it used to be around January 24 to April 24, which was a good period of the book. So we are pretty confident around on it. If there is something we are holding on to, overall credit cost of range bound between 2.6 to 2.8, and that's the number we believe is well within there. I know it's a little bit of a conservative piece. I'm also personally very confident that we should do better than these numbers.
No, sir, that is for FY26. But, you mentioned that what has to pass through will pass through. So that is all right. But given, the situation right now, what can we assume for next year?
Oh, I think next year, like we said, I think we should see as you build the quality of this book, if you're going to end this year at 2.6 to 2.7, the following year our credit cost should be between 2.3 to 2.5% here, or 2.6%. It shouldn't be more than that. That's where it is. That's the quality of business we speak of. We've always said that we'll remain between 2.5 to 2.7. Our target is to get lower than that, but that's the number.
Okay. And on the fee and other income in the ROE tree, we see that in this quarter, this has been subdued at 0.6%. So, maybe because of stronger credit filters that we have used. But, going forward, as things stabilize, where do we want this number to be? Again, more from a next year's perspective rather than the remainder of the year.
Like we said, last year this number was about 90 basis points. Think it, if you look at it on a full year basis, we should be close to 85 to 90 basis points. And as we go forward with the credit demand picking up, this number should be upward of 90 to 110 basis points on a forward looking. That's what we're working towards. So growth in funds, growth in placement, growth in bonds platform, all of these are strong fee lines, and we have all of those capabilities. Last quarter particularly was slow also because the credit demand, offtake only happened around mid of September. correct. Till then, even on the vehicle finance or some of the other pieces, we were not seeing as much of demand. As we see the demand picking up, I'm pretty confident on an overall basis, we should land upward of 80 basis points for the full year.
Okay. And on the cost
within a quarter will happen depending on the environment, what you want to do, transaction you want to take, not take. Like I said, we only represent transaction which pass through our risk filters. Yeah. So sometimes we let go of stuff which we don't think is the right thing to take for our investing partners to look at it.
On the cost of fund, we mentioned that, so we have got a 40 basis point reduction in this quarter, and we mentioned that this is just the 50% of the overall decrease that we might have. So, but this has been erratic also, like quarter before it was 8.7, and then it increased in Q1 by 20 basis point. So are we looking at this to settle at around 8%, given where repo and things are?
Atul, you want to take it?
Yeah, sure. So this 8.9% for quarter one was the overall cost for the entire book, and this 8.7 that you are mentioning is largely the incremental cost. So I think, we should settle in this range of around 8.5 to 8.6% in the next few quarters. This is what we are giving a guidance, but there is scope. There may be a 10-15 basis points lower as well, but as a guidance, we would say that we will stick to around 8.5, between 8.5 to 8.7% for the year.
No, Atul, you mentioned that, we have received around 50% of the rate cuts that have been there in the market. So what is the base from which we are comparing this? Because we are already at 8.5. So how much have we got, and how much further is the scope?
Sure. So a lot of these banks who would have, already reduced the MCLR, they would have given loans at a much higher rate. So even if their MCLR comes down, it will not be very significant, because if you recall, a year back, the rates were close to 9.30 for us. So even if they have to reduce the rates by around 40 basis points, this will not reduce my overall cost to below 8.7%. So that is the reason I'm saying we will be in the range of around 8.5 to 8.7% incremental. And for the year, we should close in the range of around 8.6%.
Okay. And just final one, bookkeeping question now. You have been taking the insurance on the MFI part. So has that also contributed towards increase in the OPEX, and how much in absolute number would we have paid in terms of premium?
We will have to get back on the exact number for that. Maybe Chetan will, circle back to you with that number.
Thank you and all the best, sir. Thank you.
Thank you.
Thank you. Thank you. The next question is from the line of Darshil Javeri from Crown Capital. Please go ahead. Mr. Darshil?
Hello. Good evening, sir. Thank you so much for taking my question. Hopefully, I'm audible.
Yeah.
Yeah. Hi. Firstly, congratulations on a great set of results, sir. So, sir, I just wanted to know, in terms of guidance that we just gave right now, I don't know if I could hear it correctly. You're saying an AUM growth of around 22% and ROA of 2%, right? Is that fair, sir?
No.
Hello?
No. We said the overall growth of 22 to 22%, 20 to 22%, and ROA of 2.8%.
2.8%.
0.8.
Okay. Yeah. Because I was just about to ask that in H1 we've done such good ROA. Yeah. Okay. That makes a lot of sense. Hello?
Yeah.
Okay.
Saying that sequentially we have improved from 2.4 to 2.6% already in Q2, and end of the year we should be in around 2.8%.
Okay. That helps a lot, sir. And sir, just wanted to go maybe in a more directional for a longer term vision. Like, we have the slide where we've shown that we've grown over 30% despite demonetization, COVID, and now MFI stress. So just want to know, like, currently when you're saying our book is performing better than what it was pre-stress, so maybe next 2 years, can be even more accelerated? Like 20% is the 25% is the guidance, but it can be towards the more higher side, because I think whatever bad in terms of macro environment was supposed to happen has probably happened. I don't know if anything worse can happen. Hopefully, God forbid, doesn't happen. But is it a fair assumption that now the acceleration phase where we can even be better than what we are performing previously?
Hey, Sashil, thanks for pretty insightful. You picked it up. Said for this year, our growth should be between 22 to 22%, between 20 to 22%. On a forward-looking, we said business, given the quality of business, we should be growing anywhere between 25 to 28% should be a sustainable growth rate on a year-on-year basis. Sometimes you have to calibrate depending the risk you are seeing, and that's one of the reasons we calibrated our growth. But the core businesses grew, like I said, our direct lending business to MSME, to secured MSME, to the overall MSME as a cohort, consumer as a cohort grew almost 30% plus. So, I think overall growth forecast on a forward-looking basis should be 25% to 28%. This year, given that the H1 and Q2 was muted and now we're seeing the growth, we should land somewhere between 20 to 22%.
Okay. Fair enough. Yeah, that's it from my side. So thank you so much. All the best.
Thank you.
Thank you. The next question is from the line of Parth Jariwala from DAM Capital. Please go ahead.
Hi, thank you for the opportunity. Sir, our credit cost has improved on the MFI piece, basically the rural business. So, what are the green shoots are we observing there? Can you throw some color there? And secondly, our provision on stage 2 has sequentially came down. So, what is the reason for that? Those two questions on my side.
Partha, you want to take it? Because we spoke about PAR 0 accretion, so maybe you want to give more granular texture.
Right. Thanks, Partha, for the question. As you mentioned, the MSME credit cost for Q1 and Q2 both is at 1.8%. And what we are seeing actually is the collections improving and the flows actually come down a little between Q1 and Q2. The way we look at it, with improved focus on collections and the flow control, this should improve as far as the MSME credit cost is concerned.
On the MFI credit cost.
MFI credit cost again, while the CGFMU is there, but in terms of the current credit cost, as you can see, Q1 was 7.7 and Q2 is 5.1%. We should expect the credit cost to improve. The net accretion to PAR, that is 1 to 90, has actually come down quite a bit between Q1 and Q2. Directionally, it is looking pretty reasonable.
Also, the advantage of using our own scorecard, which some of the other lenders also now begin to use, called New Score, helps us not only to get better approval rate, but also to eliminate potentially bad customers. And while we may use CGFMU scheme, but our sense is with or without, our quality of the book should be significantly better using our scorecards.
And sir, what would be the overall credit cost for the rural business for this year?
Currently, credit cost will be about 5.1. Currently, 5.1. Even if you
I'm asking for the year.
Q2 is at 5.1, and obviously Q1 was at 7.7, which was slightly elevated. The way we look at it overall for the year, we should be able to maintain under 5, around close to 5.
I think you see an improvement as we go forward on a quarter-on-quarter basis. Yeah, that's where it should be.
Sir. And on the PCR on stage 2?
Yeah, but on the PCR question, it's a matter of composition of what was there and what type of asset is there in the stage 2. We have seen an addition of one asset in stage 2, which required unlike a retail portfolio where the stage 2 provision requirements are significantly higher, under Ind AS, when the life of an asset is equal to or less than 1 year, the provision coverage ECL requirement on a stage 2 asset is not substantially different from a stage 1 asset if the average life of the asset is lower. Because of which, if the stage 2 composition is such that the asset which requires lower stage 2 coverage is one that has added to the pool, obviously your coverage ratio will look a little lower. It's just the model remains intact, all the rates remain intact, and it's just a composition of stage 2.
Okay, sir. Thank you.
Thank you. The last question comes from the line of Bharat Sharma from 3 Sigma Asset Managers LLP. Please go ahead.
Yeah, hi Ashish and team. First and foremost, congratulations for a good quarter. Ashish, I'm a retail investor. I want to just understand what is your overall, I'll say, long-term positioning for North Star in, vision for North Star in Indian financial ecosystem, right? Where do you see yourself in next 4 years in terms of, say, being a large NBFC or any special segment-specific NBFC? Just wanted to have an overall, I'll say, vision from you.
No, I think thank you, Parth, and it's good. Bharat, thank you, Bharat. I think fair to say the unique strategic posture which Northern Arc has is hitherto no other company. If you take a composition of the capabilities and a domain expertise Northern Arc has developed, essentially financing the credit needs of India's underserved household and businesses through a multi-channel. We run probably the most unique credit solution business, which is where we can originate large pool of retail loans, whether they are housing loans, whether they are consumer loans, whether they are MSME loans, whether they are vehicle finance, whether they are agri, whether they are solar, across the 7 sectors where we operate. We have our proprietary scorecard. We've been doing this, each of these segments, we've been doing for more than 10 years. So this means we have over 55 million time series of loan performance data of individuals, unique individuals. We then build the competence for last 15 years to take these pools to institutional investors. We placed over 1.3 trillion INR of institutional credit. We only take those places where we have exposure, where we track risk to the institutional investors, and that reflects on the quality when a paper comes from Northern Arc. And that's a unique capability. Not a transactional capability, but a unique capability. We've been doing it for 15 years. It's core of the credit solution piece to us. We can make that paper available to a retail investors for last 3 years through our bonds platform. Please do look at multifee.ai. You can download the app. We've been placing almost $2 billion through our performing credit funds, where the current outstanding is about 3,200 crores of assets under management. But since these are amortizing funds, you originate and you deploy a lot of assets. We've run 12 funds so far. 6 of them have closed. The funds which have closed have generated gross returns of 14.25%, between 14.25 to 14.5%. That's a performing credit returns. That's a return more in line with we've delivered. We right now have 6 funds which we are running. We are raising money for 3 new funds. One is in the space of climate. The second is in space of MSME. The third is also in the space of MSME, and the fourth will potentially be in the space of women entrepreneurs. So we run high impact funds, both high quality HNI and UHNI, and institutional investors invest in it. So ability to originate, ability to underwrite, ability to have a unique technology platform which none other has to process so much of data, information, 60 million, time series of loan data, coupled with then the placement business, then the bonds platform, then the performing credit funds, and our own balance sheet to support. and build on top of it risk mitigation and collection team. That's created a unique capability unlike any other institution. So that's the one part of it. Using that learning, then we said we should also build, for last 5 to 6 years, we built direct-to-customer business, which focuses on MSME, consumer, and rural. So it's a great mix and a unique capability of a very well-diversified retail financial services business with a very strong fee franchise. I think that gives us both the domain expertise, consistency of performance over the last 15 years. We've been profitable quarter on quarter, year after year. So there is a lot to speak in terms of unique positioning. And actually, if you look at on my liability profile, what Atul spoke of on cost of funds, including the core underlying profile of that, almost 30% of our borrowing comes from multilaterals, both domestics and overseas. So given the entire unique headspace, it positions us with the right to win as a diversified retail lender and a unique fee franchise between solutions placement and the fund management business. And I look at it forward-looking, I think growing at 25 to 30%, it gives us well positioned for us to be a high-quality growth franchise, getting to the late teens ROE over the next 2 to 3 years. I think that's what we look at it. And the advantage we have is given the unique nature of our business and so much of credit which flows through us, we should be performing significantly better. So our sense is from current return on assets of 2.7 to 2.8, if we're going to end this year at around that, we should get to see 100 basis point improvement over the next 4 to 6 quarters. I think that's where I'm looking at it.
No, Ashish, thanks, and really appreciate. One last, I'll say, closing question and comment. One is this, that appreciate you giving a guidance of 27-30% growth. But I assume some of this would be linked to the growth of the economy also, right? So are you probably somewhere have you benchmarked yourself to with regard to the overall GDP growth, or you are probably putting this 30%?
No, I've not said 25 to 28. I think we benchmark both the way to look at it and a banking piece is to look at it saying if the GDP is growing 7.25%, can you grow 3x of that should be doable for the GDP to grow at 6 or 7%. That's the one part of it. The second, one in the credit solution, you have a wide sector, so you can dial up, dial down, and you have the full capability between performing credit funds, bonds platform, and the balance sheet to support. In the direct to customer, a chosen field is 3, correct? One is MSME. We know 50% of India's MSME does not have access to formal credit. That's a very large cohort for us to grow, or for all the lenders to grow in that segment. Our entire GDP, 60 to 64%, is consumption-led. This means if the consumption is going to continue to happen, that means your consumer finance business should continue to grow at 25% plus. In rural India, about 10% of only 10% have access to formal credit. 90% still doesn't have. That's the power we need to bring into play. So I think we've very consciously chosen 3 key segments where we want to play directly, and we have a unique strategic posture with none other institution in a credit solution business. There are very few players which can take a holistic view of credit solution between lending placement, funds management, bonds, and all of that capability. I think that gives us a right to win in the areas we chose to play.
Best wishes to the entire team.
Thank you very much. Thank you for asking a very insightful question and making me to think. Thank you.
Thank you.
Hey, thanks. There's no other question.
Yeah, that was the last question. I now hand the conference over to the management for closing comments.
Thank you very much. We truly appreciate the active participation and insightful questions, which makes us think, makes us work harder. We stand committed to building a high quality franchise. Thank you all. Have a great weekend and have a great rest of the year. Thank you.
Thank you.
Thank you.
Thank you all. On behalf of DAM Capital Advisors, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.